Everyone keeps saying the American consumer is about to break, but what if the consumer already read that memo and decided to ignore it? We've had inflation, gas shocks, tariffs, and enough recession warnings to fill a podcast feed. Yet people are still booking flights, eating out, and swiping cards like the economy owes them a vacation. Here's the thing though, total consumer debt has climbed from $14.2 trillion at the end of 2019 to roughly $18.8 trillion by 2025. And that number alone sounds like a 5-alarm fire. But if you only read the liability column of a balance sheet without looking at the asset side, you're essentially judging someone's financial health by counting only their mortgage and ignoring that they own the house. The real story is that household assets driven by housing, stocks, and cash-like instruments have grown at roughly twice the rate of debt over that same period. That's not a rounding error. That's a structural shift in how American households actually feel about their money, even if the headlines are screaming otherwise. Think of it like this. If your credit card balance goes up $500, but your home equity jumps $10,000, you are technically wealthier, and you know it. That perceived wealth isn't irrational. It's actually the engine quietly powering every restaurant reservation and airline seat you've wondered how people can still afford. Home equity has nearly doubled since 2019, and money market balances are sitting near $8 trillion. That's a number so large it almost stops feeling real. Higher wages have also quietly done a lot of heavy lifting, helping offset the inflation that was supposed to crush the middle-class consumer 2 years ago. Now, before we all start throwing confetti, let's be honest about where the cracks are forming, because they are forming. Delinquencies in credit cards, student loans, and auto loans are rising, which tells you that not every household is sitting on a pile of home equity and a fully funded money market account. But here's the irony. Foreclosures and bankruptcies remain remarkably low, which means people are stretching, not snapping. It's the financial equivalent of bending but not breaking, and the system has, so far, been flexible enough to absorb the stress without a systemic collapse. Historically, consumer spending cycles like this one tend to follow a predictable arc. Asset-driven confidence sustains behavior well past the point where pure income data would suggest it should stop, right up until the moment it doesn't. We've seen versions of this story before in the mid-2000s. Spending held up longer than anyone expected because housing wealth felt infinite. And then one bad season changed everything almost overnight. The misconception most people carry is that rising debt automatically means rising risk. But debt relative to assets is what actually matters. And by that measure, the average household balance sheet looks meaningfully better than it did in 2019. That doesn't mean risk doesn't exist. It means the risk is more conditional and less inevitable than the scariest headlines suggest. The practical lesson here is not to bet against the consumer just because debt numbers look big in isolation, but also not to assume that current conditions are permanent. Discipline means recognizing that the two biggest threats, a prolonged market downturn and rising unemployment, are real even if they haven't arrived yet. If either of those triggers fires, the wealth effect that's been propping up spending reverses fast because perceived wealth is just as powerful on the way down as it is on the way up. That's not pessimism, that's just respecting the symmetry of how human psychology interacts with financial conditions. So the move is not to panic about the debt number and not to get lulled into complacency by the resilience. Position yourself with the understanding that the consumer can remain strong for longer than skeptics expect, while also keeping enough dry powder that a reversal doesn't catch you off guard. The philosophical truth underneath all of this is that financial resilience is never about being perfectly right. It's about being structurally prepared for multiple outcomes without being paralyzed by any of them. Discipline, sizing, and consistency will always outlast conviction and timing. We're actually comfortable with either direction this plays out, because rational preparation, not prediction, is what protects you when the story changes. Whether the consumer keeps spending or finally flinches, the households and investors who survive and thrive are the ones who built their positions around process, not hope. And if you want to put that kind of thinking to work in your own financial life, whether through real estate investing, home contracting projects, or connecting with the right lenders, check out our links in the description below.